U.S. stocks fell sharply Thursday, a day after the Federal Reserve raised rates again. The Dow dropped over 760 points, its worst day since September. The Nasdaq closed down more than 360 points. The S&P also tumbled nearly 100 points. The markets also reacted to a report from the Commerce Department, which showed a 0.6% decrease in retail sales last month. For more on all of this, I'm joined by Greene. She's a senior fellow at Brown University and the global chief economist for the Kroll Institute. The Fed announced they were raising rates, which surprised exactly no one. So why did the market react this way?
Yeah, it wasn't the rate move that really surprised the markets. It was the rest of the messaging. The Fed also released its new set of economic projections that showed a downgrade in where they thought growth would go for the next 2 years, an increase in where they thought inflation would go for the next 2 years, and very importantly, an increase in where they expected rates to go over the next 2 years. And their message was really clear. We're hiking rates above 5%, and we're going to keep them there. They've been pretty consistent with that message. The markets haven't been listening. And so effectively at this meeting, the Fed said, no, we're really serious about it. And I think the markets started listening. On top of that, you had the ECB come out today with a very similar message. You had bad retail sales data, bad manufacturing data. And so the idea that we're actually really slowing down, the economy slowing down, I think, took hold in the markets, and investors became more concerned about the economy than they are about inflation.
So the markets really got the message maybe this time. You mentioned that the Fed in its assessment of the economy said they increased their assessment of where they thought inflation was going. But people might say, wait, I thought the inflation numbers were getting better. Did they get it? Are they still kind of getting inflation wrong at the Fed?
No, so they still have inflation coming down over the next 2 years. So that's consistent with inflation coming down in the past 2 months. They just don't expect it to come down quite as fast as before. If I'm really honest, if you looked at all of their economic projections, inflation, unemployment, growth, rates, it's not internally consistent. And I think the real missing link is why they think inflation will be higher than they thought it would be 3 months ago. It's not really clear. I think ultimately the Fed is really just worried about financial conditions. As long as the markets aren't buying the Fed's story, then financial conditions are easing. That means that the Fed will end up having to tighten even more to achieve their goals. And so the Fed's really trying to lean against that.
Another number in the Fed's passel of numbers there was they said they thought unemployment would increase to 4.6% from the current 3.6%. In your view, and then the Fed said it would basically stop at 4.6. Is that the way it works? I mean, in other words, isn't it also possible once the layoffs get going that they could snowball and the unemployment rate goes above 4.6?
That's possible, and I actually expect that unemployment will probably go above 5%. The Fed's argument is that we have so many job openings, over 10 million, that actually we can just whittle down the job openings as the Fed tightens policy. We don't have to see a dramatic increase in unemployment. The problem is if you look at the data and look at what's happened in previous rate hiking cycles, there's literally no precedent for that. So it's a really nice theory that has no grounding in history or the data. And so I'm skeptical that can happen. What's really different this time around from previous times, though, is you have a lot of labor hoarding. So companies have had a really hard time finding workers. And so they're reticent to lay them off because they know that on the other side, they'll have to find them again. And it was so hard the first time around. So you do have companies holding on to workers. How long that can last is unclear. I think as companies work through their cash cushion that they built up over the pandemic, they may have to start letting workers off. And then I think the labor market will deteriorate. I think unemployment will rise more than 5%. People will really retrench then, and that's when we'll go into recession. I expect it in the second half of next year.
And as a final question, Megan, you study the UK and U.S. economies. You mentioned the European Central Bank. In the UK, rates are at their highest levels in 14 years. How would you compare the actions of the two, or are they exactly the same, and that tells us something about the U.S. economy relative to the global economy?
Yeah, so the Bank of England and the ECB both hiked rates by 50 basis points today, following in the Fed's footsteps. And their narrative is pretty similar, although the UK is already in recession, so it is different there. But I think effectively every other major economy is having to follow the Fed, whether those central banks feel like they can do much about inflation or not. If it's more supply driven by energy costs, for example, there's not much central banks can do, but they feel like they have to follow the Fed, because otherwise you get a huge currency move, which we've already seen. The dollar's gotten a lot stronger. It's started to weaken more in the past couple of weeks. And if the dollar is really strong, then these other central banks are effectively importing inflationary pressures. So that's totally undermining everything that they're trying to do. So they've got to move lockstep with the Fed.
We're all in it together, and the we is the globe. Megan Greene, thank you so much for being with us.